YouTube as well. All right, so this is good. I'm just making sure everything's on there. I can see, and I'm going to share the various workspaces in a second as well. Just making sure I've got, there's quite a few things I want to show, different to what I did at lunchtime. If any of you missed the lunchtime one, I've just added a few more things. By the way, let me just share my screen as everybody's on here on screen 5. No, it's screen 3 I want. Screen 3. Where are you, screen 3? Let's share screen 3. That's what we want. You should be able now to see both me and a computer screen as well. Just let me know that you can indeed see that, please. That'll be great. If you let me know that you can see that. And that helps me know everything that's going on. So just let me know you can see the computer screen as well. I believe you should be able to, and that would be absolutely fantastic. And we are launching, we're live both on YouTube and on Zoom. Isn't that fantastic? Right, now I'm going to run through what I think are some of the best investments at the moment. And it's not just me saying it. What I do is I x-ray into the portfolios of people like Jim Simons and all sorts of other big names who are the phenomenal people out there, and make sure it's them as well. So I don't just rely upon my analysis. So I'm going to go through all of that. Like I said, just want to make sure, let me know where you're from as well. Everybody just type in where you're from in the world as well, while everyone's just settling in. Just let me know which parts of the world you are in. Okay, so I can see where you're from. And that'd be fantastic for me as well. Like I said, I have, there we go, Greece, Portugal, good, good. And you can all see my screen, can't you, as well? Good, 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 it can. Beaconsfield, lovely. Nigel, Louis from Portugal, and Mark from Greece. Fantastic, I can see everybody's out there from everywhere. Good, 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 good. Let me just get on with it then. It says that 3 participants have raised hands. Forgive me if I'm a little bit slow on some of these things with all of this, but we're going to go. Right, are you all ready? 1, 2, 3. I think we all are, and we're good to go. So first things first, look, if you haven't already, join me on LinkedIn. You'll be able to see some of my credentials. Very important when you're looking at anybody on the internet or on YouTube or such like, that you know who the hell they are. And one of the best ways to do that is to follow them on LinkedIn, because you will see who they're connected to and what those connections, such as people from major banks, CEOs of hedge funds, say about them. Okay, and that's very important, because when you see that and you know what people are saying about individuals such as that, it gives you a very, very good idea of their credibility. Now, I'm going to talk about my experiences both as a hedge fund manager, but also in terms of the other work that I do in government as well, and give you the best stock picks that I can. I won numerous competitions picking stocks, both in the Financial Times and elsewhere. So the British government asked me to do that for them. So essentially, I'm one of the government's deal makers. My job is to find the most outstanding companies from around the world and bring them to the UK. If you've been following me for the last 15 odd years, you'll know that's what I do for the UK government as well. So not only am I a stock picker in my own hedge fund, I am also essentially a stock picker for the UK government. I'm one of Her Majesty's government's deal makers. I've got cards here somewhere. It really does say that on the business card. It really does say deal maker. There you go. Enough of that. Now, let's get on with what I'm going to talk about in this quick webinar. I'm going to give you some of my best insights on investing. This is very much about investing. I want you to know that. Okay, and as such, what it does is it goes through, well, some of the things that I've written in my various Financial Times published books, but also what this man taught me, Bill Lipschutz, who was head of trading at Salomon Brothers. His boss at the time, his chairman, was Warren Buffett. He was one of my mentors, was Bill Lipschutz, not Warren, but Bill Lipschutz. And he was in this book and many others. It's not a plug for the book. I'm going to give you the best investment ideas that I've generated from there, and also show you how I won the various competitions in the Financial Times and so on and so forth. So that's just the start of it. What this important information and disclaimer says to everybody over there is, please don't assume this is direct personal advice, because I don't know you on the webinar, okay? So I can't give you direct personal advice. You might be in need of, I don't know, pension advice or whatever else, but we haven't met. I don't know who you are. So this is not personal advice. This is education, which is, the idea is it's going to give you some fish, i.e. some ideas as to what I like, what Jim Simons, one of the world's greatest investors, likes, Warren Buffett likes, and so on and so forth. Give you 7 strategies to adopt into your portfolio, help clear your thinking, and also it's going to, as well as teach you how to fish, which is what that is, give you some fish. So I'll give you some stocks and I'll teach you how to get your own. All right. First things first, please, notepad, please, if you wouldn't mind. And you're going to need a camera. Where's my phone? You're going to need a camera phone. And the reason you're going to need that is you're going to want to take pictures of some of these slides because you might not be able to see them again. Okay. So make sure you've done that. And also, just because it'll be reassuring for me, just let me know you can still hear everything loud and clear. And you can see on screen, where it says checklist. Just let me know you can see a slide box which says checklist, okay? As I say, Zoom isn't always the most sort of user-friendly, so I do get a bit worried in case I've missed something on it. So just let me know you can indeed on there see a slide, which I think you can because I can see it on YouTube. So great. All right. Now, first things first, please leave now. Please disconnect if you want to gamble. I'm not here to gamble. I'm not here to say to you, oh, you know what, this tiny little company nobody's heard of, which is trading at 1%, well, they're probably going to get a contract, probably from somebody somewhere I heard in the pub, and that could mean it could double up by tomorrow morning. We're not here for that. If you want to go do that, there's lots of places on the internet where you can gamble and lose your money. I think they're called Ladbrokes. Okay, that's where you go if you want to gamble. We're here to make money in a professional, systematic approach. All right, simple as that. Now, let me tell you something else that's going on at the moment. NASDAQ, the US technology index, is up in the last month nearly 20%. The UK market's up 10%. The Dow, which is the 30 largest, well, not 30 largest, the 30 stocks in the United States, it is pretty much the largest, is up 13%. All right, that's up 13%. Now, what that tells you, my friends, is that we've had a big rally and we want to make sure we're going to get, are we missing out? Is it going to continue? What if it falls? How do we make sure we're covered in both directions? Because since the start of the year, this is what's happened. Now this, my friend Wade, I know you're from the United States, but a lot of people on this webinar are actually from the UK. And if you're from the UK, look what's happened since the start of this year. You're down 26% still. If, like me, and if you've been following me, you know this, you've been investing in technology companies, then guess what? You're up already significantly. And if, like me, you bought more of those technology companies when the market fell, then you're probably doing up at least 20% so far in the past month, let alone the fact that your portfolio has not suffered since the start of the year there. But most of you on this webinar, and you can put your hands up, have got shafted, I'm afraid, because you're down closer to the UK version. And the UK version, the UK example is minus 26%. That's not to, I'm not talking down the UK. What I'm saying is when you are invested in your domestic economy, you are limiting your options. Not only that, you're missing out on a hell of a lot of opportunities for return. So people like me, British, have got a bunch of Americans in NASDAQ, the NASDAQ 100 companies, which are some of the largest companies in the world, like Apple, whatever, okay, working for us, and they pay me rent because I'm the capitalist shareholder in their companies, and I get to spend that money in Britain. Fantastic. The point is, it's not unpatriotic to own overseas shares. Even worse, you're seriously screwing your pension funds or your long-term investments if you don't have. Now, this is something that I've written about in my Financial Times columns. It's not plugged for my various books. I've written about it in these brilliant books by Palgrave Macmillan that I've written over the last 20 years. Don't buy the book. I'll give you copies of this. Well, I'll tell you how to get copies of it later. Okay, I've had international bestsellers. Don't buy the book. I get a pound in royalties, and I'll tell you all the best bits into that in this webinar. This webinar is going to teach you all of this. Okay, so watch the webinar. I'm going to try and keep the webinar to an hour. All right, because it was short notice, but I had so many people emailing me to do it. All right, okay, so that's why we're going to be looking at some of the things we're going to look at, because there is a massive difference between being up 4% and down 27%, right? So how do we make sure that so many of you who've had your portfolios absolutely shafted and screwed in the last few months get a grip on things, all right? Not just for this year, not just for 3 months. If that's what can happen in 3 months, imagine the compound effect over a number of years, okay? Let me put it a different way. The NASDAQ has completely erased all the losses it suffered in 2020, all right? That's a clearer picture. That is nuts. So much for the absolute panic and disaster. And not only that, in April, global equities, okay, worldwide equities. So I don't care if you're from Greece, Portugal, as my friends are, or Australia or America or whatever, they've had one of the best months they've had in half a generation since 2009. We do not want to be missing out on this kind of stuff. Why does this kind of stuff happen? Well, as Goldman Sachs have said time and time again, and I wrote this, by the way, in the Financial Times a few years ago. You know, I wrote this after 9/11. This bit I wrote in the Financial Times in my column after 9/11. The US in war and crisis begets a bull market. Virtually every single time without fail, 12 months after every major US crisis in the past 60 years, you will get massive stock market rises. Now, the problem here is this. How come I know that and you don't? How come I know that and you don't know what to do about that? You don't know how to simply what to buy, where to buy. So we've got to level out that playing field. We've got to make sure that it's not just the insiders with the data, but it's you guys who also have access to it. That's the point of this webinar. Very simple. That is the point of this webinar. And I'm going to teach you 7 strategies for you to look at. For investing, we're talking investing, holding things for minimum 9 months, probably for 18, maybe even 24 months. That's what we're going to talk about. This is the 1-month performance of companies around the world, okay, which are all listed in the United States stock markets. In other words, I can buy these the same way, sitting in Britain through Barclays Stockbrokers or Hargreaves Lansdown or AJ Bell or Halifax or whoever, or if you're in the US through Schwab, obviously. All of these companies are listed. They're called ADRs, American Depositories. So Alibaba, major Chinese company listed in the US, but you might not know about it. As I've written in my Financial Times column, which I'll keep referencing, so you know that this is not just stuff I pull out of the hat, but it's been published in a newspaper where the most financially savvy people in the world read, okay? So which of these do I like, okay? And why do I like them? I don't just pick out names. They've got to fit in a strategy first. You don't just say, oh, well, quite like Alibaba. Why? What's the strategy? What's the reasoning? For how long? When are you gonna sell it? Okay. What if it's a profit target? What if it's a time target? What if it's a loss? It's either going to go up, down, or sideways. So if it goes up, when do you sell it? If it goes down, when do you sell it? If it goes sideways, when do you sell it? Okay. Up, down, sideways. When do you sell it? Right. So we need a strategy. So I'm going to break down 7 strategies for your consideration. Okay, in this. Now. So we're going to look at some of these. These names are going to come up. They're not going to come up in a haphazard way. They're going to come up in a systematic, professional way. By the end of this, I want you guys to be well on the road to be good enough to work in my firm as fund managers, okay? That's how good I want it, because I train up the people in my company, and I want you to be that good. It's as simple as that. Andrew Bannister, Colin Groves, I can see you've got hands raised. Let me know if there's any issues and what is going on while you've got your hands raised. All right, so if there's any issues, let me know. Any problems, let me know. Okay, now let me move on to the next slide in that case, right? Which is this. These are just American companies, right? Now, this is their performance in the last month alone. Amazon, would you believe, last month alone is up 21%. Okay, Apple is up 23%. Microsoft, 17%. What the hell? There's supposed to be a global crisis. Facebook, 34%. Google, 23%. What the heck is going on? All right, let alone these. So how do we know to pick and make sure we get the right ones and we get the choice? I'm going to show UK companies as well and European. Don't worry, I'll give you the whole shebang. But because the universe from which I pick my stocks is global, because the window I have through my computer screen is to the entire world, my choices are better. Therefore, the quality of my stock picks are better. One goes after the other. My strategies, I'll explain what they are. And they're not just my strategies. There's a reason for my strategies. I won competitions in the Financial Times, and then the British government said, will you do this for us? Okay, pick stocks, find companies, the best in the world. Now, one of the reasons all this is happening, by the way, is the IMF, the International Monetary Fund. Okay, what they're saying, what they're telling the world, is this. China, 9.2% rise next year. UK, 4% GDP growth. The UK's not had 4% since, blimey heck, God knows when. Okay, what, 1950s? US, 4.7%? They should be dancing in the streets. A major developed economy getting 4.7% like America. This is what the IMF is saying. This is not me, okay, getting over exuberant. This is the United States. We better get lined up for this, because what's actually going to happen right now is a lot of people have seen their investments crash or are on the sidelines not knowing what to do, and they're going to miss this as well. They've already missed last month. They're going to miss this as well. And you know what the worst thing is? There are people, I kid you not, the economy could be going through a boom and it's Sod's law, they will still pick trash. So we're going to get rid of that. We're going to stop you picking trash. There are those who don't know what to pick. There are those who will still pick trash. We're going to give you a disciplined, strategic approach in this webinar. So we're going to improve you in the shortest space possible. By the way, that's talking about up, 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 up. Well, surely if things go up, it's easy. Buy an index tracker. Hang on. What if it falls? Did the S&P ever make a new low after a bear market? We were in a bear market, okay? So let's look at 100 years worth of data. And 60% of the time, lo and behold, the market does indeed fall. So we better make sure in our strategy, we're not gambling that it's only going to go up. We better make sure that given 60% of the time when we just have happened what just happened, i.e. there's a big sharp move and we go into a bear market, 60% of the time, it actually rises, then goes back lower again. It what's called retests the low. It makes a new low 60% of the time. So we better make sure whatever portfolio you have, because these portfolios that we have are for our pensions, they're for our children, our grandchildren. I know this because you guys email me in and say, I'm picking for my son, I'm picking for my daughter or my grandchildren. I'm 63, I want to give this to my grandchildren, or I'm in my 20s, I've only got a few thousand, but I can afford to take more risk. I don't know what to do. So we've got to make sure whatever we pick, if the markets go up, it's the easy scenario. We've got something which is good for that. And if it falls, we're still safe. So how do we do all of that? Now, where am I getting all my data and information from? Well, part of it is my experience for 15 years as a hedge fund manager. Okay, these are some of the funds that the company I set up runs. We have private equity funds and hedge funds. This is not marketing to you. It is a criminal offense for a hedge fund to market to retail clients. You're all retail clients. We only have institutions as investors in our fund. So I'm not marketing to you guys at all, just so you know. I have no conflict of interest with you, which is great news. Okay, I'm not a stockbroker. I'm not trying to get you to churn your trading. Stockbrokers try and tell you to trade. They don't want you investing. If you invest, they don't make any money. They need you to churn, churn, churn. And stockbrokers, there's a reason. Look, a stockbroker, if there was a sort of evolutionary cycle, the stockbrokers would be at the bottom. The long-only fund managers, long-only as in, Neil Woodford's would be next. And then you got the SAS and the elite, which would be the hedge fund managers. People like Jim Simons, Stephen Cohen, myself, if I may say so. Okay, the ones who, by the way, I should say I was not born with a silver spoon in my mouth. I was born in Leeds, in a little place called Armley. And this was all self-taught, which is why I have a mission to make sure whatever networks I have, information, data I have, I teach people this. And it's not, and I've been doing this for 20 years. Okay, see the books, 20 years I've been doing teaching people through the Financial Times columns and through the books. And when you're good, institutions find you. And so I set up my own fund. Okay, my hedge fund, which I said institutional only. Everything I tell you tonight, I have tested and put out there in the Financial Times, and it's been published in the Financial Times. They don't publish rubbish. 200 columns published in the Financial Times, which means that I'm giving you the best of the best, which they felt worthy of giving to the rest of the world. All right, so let's kick off with this. Assume you have a plan to invest over 10 years. Now, one person said to me at lunchtime, he said, Alpesh, hang on, I'm 63. I don't have a plan for 10 years. Okay, yeah, but you might want to invest for your children. So whatever you're investing, it's going to go to somebody, isn't it? Because you can't take it with you, right? So assume you plan to invest over just 10 years, whether you're 20 or 60 or 70 for that matter. And you, with my help and some of the things I'm going to teach you, make, say, 20% per annum. Some years you might make more, some you make less. Nothing extravagant, nothing pessimistic either, okay? Let's say you have 100K, way more than what many people on the webinar will have, but just assume for a second, because maybe in 10 years you will have 100K, maybe in 20 years you will, and we can do the maths for those times as well. Okay. You also plan to add maybe 1.5K each month to your portfolio, right? Each month. That's a lot, but you know, you're one of the more mass affluent, right? So let me tell you what will happen on that calculation, just so you know the maths. You will have over 1 million by the end of 10 years. You'll have over 1 million by the end of 10 years. That's what will happen. And this is the maths of it. Over 10 years, and you know what the critical factor of this graph is to get you to becoming a millionaire in 10 years, a millionaire in 10 years? You know what the critical factor is in all this maths? It's that 20%. It's actually not how much you add each month. Okay, of course, your starting point is important, but we're talking about a tenfold increase over 10 years. It's that number which is critical. So we need to try and hit that number. We need to focus on that in our business plan to make that right. But hang on, there's many of you with far more modest means at the moment. So let's assume you've only got 10K to start with, okay? And you plan to add 6,000 a year, so 500 a month, 500 a month, far more modest. Still, I know for a lot of people, a lot of money, but let's say you plan to add that to your portfolio. Then your returns look like this with my help, if we get the 20% per annum. And by my help, I mean the education I'm going to give you in this webinar, all right? I'm not going to be managing your money, just so you know, and I'm not your stockbroker. I don't have a stock brokerage, all right? So just so you know, with my help, as in the education, what I'm going to teach you in this webinar, what you're going to learn in the remaining 45 minutes, okay? That's what it looks like. We've extended the time frame a little bit because you started off with less capital. So presumably, if you've only got $10,000, it's because you're in your 20s, 30s, maybe even early 40s, okay? Early 40s and living in London, right? That's where you end up. You end up with about 600,000. Now, if you were doing this in pounds, you just change that to pounds. My point being, you end up with 600,000. You end up with 600,000. You start with 10. You end up with 600,000, right? You know what's critical in this figure? Have you noticed how this just accelerates? It's actually years 9 to 15. It's important to start, but what else is important? The things you're going to learn in the next 45 minutes, because their job is to get you this. Their job is to get you this, right? So I'll tell you what the two most important figures are. This one, the next 45 minutes, right? And the later end of the curve, because it just goes exponential. Okay, so let's look at that. This is my son's junior ISA. My son was born in 2018. In a junior ISA in the United Kingdom, you can only put £4,000 maximum per annum. Okay, so it's only been going since 2018. That's his. I'll show you mine in a second. My pension, not my junior ISA. I'm not eligible for a junior ISA. Okay, and that's all he's got. That's all he's got. He's only got 4 stocks. Well, he's only got 4K in year 1. This is the year 1 figures. Year 2 is just an addition of this, okay? So we're talking 8K in total. That's all he's got, right? Plus, these are the returns. So he's hitting 48% over those years, or 24% per annum. It is doable. And that's up to date till about 6:30 p.m. tonight. What's my point? My point is, yeah, there was a crash that's just happened in between all of that, and we're still hitting 24%. So let's expand this out. I'm not saying you buy these now because you need a time machine to go back. Are these still worth buying? Why the hell's Premier Oil in there? Why is Globant? What the hell's Globant? Who is Globant? Argentinian company, by the way, software. What? That's high risk, multi-billion-dollar company. Anyway, how did you come to these? Why would you, given it's your son's future, he's my only child, given it's your son's future, why did you pick these? That's pretty serious stuff. Okay, I'm also going to show you what's in mine and what I advise my sister. And I can tell you something else, guys. When I tell you, never mind the British government, they're not going to assassinate me, and the picks I might do for them. But when I am on the BBC and there's 300 million viewers there, that's fine. Okay, I pick stock, they follow it up, they go, okay, or on my Bloomberg show and all the rest of it. Okay, or Working Lunch, if you remember that back in the day. If I get it wrong for my sister, I'm dead meat, right? My son's too young to tell me off, so I've got a very big incentive to get it right. So I'm going to share some of that with you. Part 1, very quickly. I'm going to do this in about 10 minutes. What are the biggest investing problems? And then we're going to do the bulk of the webinar, the solutions. The stocks I like, Goldman Sachs likes, Warren Buffett likes, Jim Simons likes, for 100 to 500% returns. We're not talking high risk, and we're talking longer time frames. Where the hell did you get those figures from? I'll back it up, okay? And it's not my figures, it's theirs, okay? So we're going to do that. Ready, steady, go. First, big problem, picking stocks This is the main problem private investors have, is they're picking stocks like they're hoarding, right? They have no reason to be buying 2 lots of toilet rolls or a BP and a Shell. They're the same bloody thing, but they do it. And they just buy what they see or name recognition. There's been academic research to prove this. Ample academic research to prove this, that people buy stocks based on name recognition. So they end up with a load of crap like this fat bloke here, all right? And that wasn't me, by the way. Hairy arms, still not me. Problem, you also don't know when to let go, right? When you got the stocks, I've had people email me, go, oh, I don't know what to do. I've got a whole bunch of stocks. I don't know what to do. Do you know how much waste and opportunity cost arises? You could probably have been a millionaire, some of you, 10 years ago, but you did this, right? This webinar could have, you know, if we did it 10 years ago, could have seen some of you, if you knew how to let go, instead you end up holding it forever. And some of those stocks end up dead. Right, very quickly, and this is something you might want to take a picture of. Markets can only do one of 2 things. All our strategies we're going to talk about are going to be based on these 2 factors. Markets can either go up or they can go down. Let's take the situation. This is a decision tree. Take a picture, photocopy it, whatever. When they go up, you're only going to have 3 types of stocks in your portfolio. They're either going to be quality stocks, and I'll define what they are in a moment. If they've gone up, I will buy more of those because I plan to hold them forever. Right, I'll explain what these are in a second. Quality stocks are the type I will buy more of no matter what, because I want to hold forever. They're what Warren Buffett, Jim Simons, Paul Tudor Jones call Amazon, Apple, Microsoft, okay? Those are all Alphabet. They're all quality stocks. Now, some of you are going to go, no, they're not. Great. You're better than $1 billion hedge fund manager. Good for you, right? And I'll show you why they're quality stocks and which portfolio they fall into in a second. Then you've got performance stocks. Now, this is what most of you want. By the way, none of you want quality stocks. You should have, but you don't. You're thinking, no, I don't want that. Heard of that name, don't want it. Fine, okay? Just wait a second. I'll show you what makes people rich and what doesn't. What you're all really after is performance stocks. What you usually end up with is low quality stocks, well, the ones you shouldn't have owned. And when the market rises, you got lucky, you do self-attribution bias, which means you attribute the market rising to your skill picking. And so you say, oh, I'm really good at this. And then when the market tanks, you blow up because there were low quality stocks to begin with. What you're really after, most of you, is performance stocks, but you should be getting a mixture of performance and quality. And performance stocks are these. Either when the market goes up, which is what we're talking about here, you hold, okay? You hold them because it's gone up. Or you buy according to your strategy if it's in one of the 7 strategies I give you, but you've got to be careful because they're not quality stocks, they're performance ones. So what's a performance stock? Let me explain, right? Time passes, the market went sideways. Well, if it's a quality stock, you might buy more because you're going to hold forever. A performance stock, well, time has passed. So it's either hit your target, price target, or your time target. You only have 2 targets, price or time. If it hits your price target, you will sell. If it hits your time target, i.e. 12 months is up or 9 months is up, then you look, is it still in one of the strategies? If so, I'll hold, else I got to get rid of it. And if it's a low quality stock, you've got no business owning it. Don't talk to me about it. Most people, when they email me, they give me a list of low quality stocks. They might even post some nugget. Alpesh, what do you think of? I'll be like, well, I don't know. I don't have a database of 30,000 stocks in my head with all the statistics, obviously. So I'd have to go away and look at it. Now, what if the market falls? Because I said there's a 60% probability we'll retest our new lows. This is the clever bit. This is the important bit. This is what separates the men from the boys, the girls from the women, etc., etc. Okay? When it falls, there might be quality stocks, in which case, if they are, you buy more. For instance, I happen to know Apple is a quality stock, so I'll do what Warren Buffett says. If it falls 20%, I'll buy more. That's the easy bit. Any idiot can do that. You don't need to be on this webinar for that. What do you do here? Right? If it's a performance stock, you hold it, you never buy more. You never add to a losing position. And if it's low quality, well, you shouldn't have bloody owned it in the first place, so stop talking to me. And if it then continues going sideways, same thing. Quality stocks, buy more, hold. Performance, well, hits your time target at 12 months, so you sell, or it's still in one of the strategies, so you hold. Simple as that, and get rid of the low quality ones. Decision tree makes your life a lot simpler. I'm going to make it even simpler in a second. Problem 1A, rubbish fund managers. Right? You can be better than an overpaid fund manager. I am not here to say to you, give your money to a fund manager. Don't do that. Listen to me. Don't do it. Hedge funds are the best in the world. They can't take your money anyway because the law prevents it in every country. of hedge fund managers managing private investors' money. Don't ask me. Well, I do know why. The only people, therefore, you can give it to are the rubbish ones who couldn't get jobs at hedge funds. People like Neil Woodford, people like him, who I, as a private investor, have beaten every other UK company fund manager ever since. Okay. Patel is top FTSE 100 forecast. That's the business section of the Financial Times. That's me winning the darn competition, and that's Neil Woodford, just above the cat of the editor. All right. Now, you might think, well, you're just picking on him. That's just one individual who was rubbish in 2004 and was rubbish in 2017, and lost private investors lots of money. Well, actually, no, 99.4% of these long-only fund managers, they're the ones who can't get jobs in hedge funds like mine. All right. They're the ones who work at firms which do lots of advertising. You see the adverts, you don't know any better, so you just give them your money thinking they're experts. No, you're the expert. I'll show you why. One of 7 strategies. We get the right data and we do it, right? And by the way, if you want to know the source of this information, New York Times, 2008, and the person who wrote this article was the basis of this research, went on to win the Nobel Prize in economics. Okay, you didn't know that, did you? Yeah, it's not your business to know, it's mine. Sadly, there are also rubbish private investors. Why? Well, the average private investor, according to Bloomberg, which is the #1 source in financial information in the world, nobody will ever contradict that. Okay, there are very few truths in life. Taxes, death, and Bloomberg is the best source of financial information in the world. Effects of panic attacks on average investors. 20 years annualized returns, 1999 to 2018. The average return for the average investor is 1.9%. So the answer isn't, oh, fund managers are rubbish, just do it yourself. Because if you don't know what to do, you're not going to get any better. Got it? So we need to improve. Second problem, you don't know where to look. Most people are like this. You don't know where to look, so you're like this, okay? And then you've got paralysis by analysis because you don't know what to look for. If you do know where to look, you don't know what to look for because you see data like this and you think, shit. All good judgments in the world, whether you're going to be a billionaire or whether you're going to be a politician or whatever you're going to be, a surgeon or whatever, is based on 2 things. One is the information to look for, and secondly, how to weigh it. So what's important and how important is it? Right? Not everything's important. Only 5 things in most decision making are important. And your ability to weigh well, first of all, to find what those 5 things are in anything you do in life, whether it's picking a wife or a husband or whatever, or picking a stock, right? There will only ever be 5 things, it's just statistics, which will be the most important, right? The minutiae of 5 billion other things can be left in the trash can. When you're hiring somebody for a job, there'll probably be just 5 things you look for, right? There could be 1,000 things you could pick on, but actually the others are just a long tail. My point in this webinar is I got to tell you that based on 100 years worth of research from various analyst homes, which I'll show you, analyst houses, what are those 5 pieces of information which are important and what's the weighting you should give to them? Because you do not know what to look for, so you get paralyzed. And in the end, you say, you do one of 3 things. You do nothing, or you say, screw it, I'll give it to an expert, or you end up looking at the wrong things and just buying something bad and rotten, because 90% of stuff is crap out there in terms of stock. Okay, so we're going to remove that problem. We're going to remove this problem, expensive courses and subscriptions. It is my job to pay for subscriptions like Bloomberg, which is $2,000 a month, and I probably spend another $2,000 to $3,000 on other various things. It's my job to have those subscriptions. So I pay a subscription to find out what's in Warren Buffett's portfolio, what he's just traded, and Jim Simons, and Paul Tudor Jones, and Stephen Kane, and a bunch of others. I pay a subscription to find that information. Then, like Robinhood, I take that and I give it to you guys. Okay, shoot me, and I get rid of all the extra gumph. Right, so I'm going to do that in this webinar for you. Problem 5, who to trust. Now, I'll tell you what I mean by who to trust. The S&P is roughly at 2,900. These various banks are saying by the end of the year, Bank of America Merrill Lynch is saying it's going to be 300 points lower, okay? Whereas Citigroup says it'll be 200 points lower. Deutsche Bank says it'll be 350 points higher. Goldman Sachs says 100 points higher. JP Morgan says 500 points higher. Who the hell, what? Who do I trust? Wait a minute, that's supposed to be the sum collection of the best and brightest and cleverest. Shall I tell you a little secret? I went to university with some of the people who work here. They're not the best and brightest and greatest and cleverest. If they were, they'd be running a hedge fund. They would not be working at Goldman Sachs, pulling down a salary, I'm afraid. Don't tell them I said that, okay? What I am telling you is, wait a minute, you can't even trust the difference between a Goldman Sachs and a Deutsche Bank. They don't even know between themselves in the closed world of all of this. Now, since we're talking about trust, I better justify myself. Okay, these are some of my past and present clients who pay to have me speak to their audiences. Merrill Lynch, HSBC, American Express, Goldman Sachs, Financial Times, blah, 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 Barclays, Lloyds, and so on. Schwab pay me to speak to their audiences. So I'm going to suggest humbly, if I may, that you might want to listen to me. I'm lucky enough that they even do my book launches occasionally. I'm very fortunate in that regard. Okay, so you might want to trust me. And let alone that I've been vetted, due diligenced, and probed because of I'm a public figure. I'm, what I say goes out, whether it's on the BBC or in my books, and if I get it wrong, I'm screwed. Okay, and also my country trusts me. As I said, they trust me as well to get it right when I'm looking for companies around the world. You know what one of the biggest problems is? I should say, that's me. Woo! Okay, I'll tell you what one of the biggest problems is. There's a massive rich-poor divide in information. I know, and the people who read the FT, that's my columns in the FT, they read me, they know what they should be doing. You probably don't have the time or inclination to read all of that, so you don't know. So we've got to level that out. Not only that, people like Barclays will send me things like this. Don't worry if you can't see this. Okay, I'll explain what it is. It is the likelihood of the big themes happening and the impact. And so they're telling their wealthiest clients, these are some of the biggest impacts, and then they're telling them what stocks they should position themselves in within that. And that could be a self-fulfilling prophecy, whatever it is. I need to be on top of it. I need to know, right, what are they telling their clients? Because that can move billions of dollars and could be self-fulfilling, and I need to be ahead of that. So I'm going to share some of that with you in the 7 strategies. Okay, so these 7 strategies I didn't pull out of my bum. They came out of examining all of these problems and how they should be solved, including what are the best ideas of the biggest hedge funds. According to research from these people, they discovered that the best ideas of hedge funds were outperformed the best ideas of any other category of people, but you don't get access to that. So I'm going to give you some of the picks that they say, which I then analyzed to double check on what I liked. Okay, and I'll try and put a risk assessment on each one. And I'll also tell you what UBS is saying for the year ahead, and Goldman Sachs and their conviction list of their best and brightest ideas. Yeah, Goldman Sachs, best and brightest ideas. I'll share some of those with you. The reason is this: the market in some cases has fallen in some stocks from 100 to 50. So those stocks have gone down 50%. If they go back from 50 to 100, you double your money. Some have fallen 90%. If they go back from, so they've fallen from 100 to 10, if they go from 10 to 100, you've got a tenfold increase in your money. But we need to know, did it fall 90% because it was rubbish? What's the likelihood of it going back? When will it go back? Are there some other ways I can be assured that these are going to be safe? What's the level of risk? For instance, can you show me an X-ray? Is Warren Buffett owning some of these? Problem 7, you don't know which broker and you don't even know how to buy. That's fine. You might be a total beginner. I'll show you and explain that. Problem 8, you don't have an inside mentor who gets access to things like what Goldman Sachs are telling their wealthiest clients, which is we're roaring into a recession, and they're giving them some things to fall back on. So what are some of these big banks saying? Well, Schroders are telling their wealthiest clients to get into FAMAGs. Do you know FAMAGs? Put your hand up if you know FAMAGs. You probably don't. These are the FAMAGs. Well, if you've been following me, you know I'm already into them. But having said that, that doesn't take a genius to say Microsoft, Alphabet, Apple, Facebook, Amazon. Surely, no, you're right. That's my low risk, hold forever, high quality, cash rich. When the market crashes, they'll still be there. But what about the exciting stuff? Well, these are the best ideas of stocks across funds as of the end of 2019. Hedge funds with over $1 billion, this is what they picked, and all hedge funds. In other words, the insiders at the various hedge funds are putting their money into these. So I look through these, and guess what? I don't have an issue with owning any of these. I think they should give me a 50% return in about 12 months. It might take 24 months. I'm willing to wait. I would put these on the lower risk category for me. Okay, I'm not saying hold forever. I will reevaluate these. These FAMAGs are hold forever. It's what Schroders, who probably control directly or indirectly about $10 trillion worth of wealth probably. Okay, so what I also want to do is give you some other background of the strategies and what Goldman Sachs are saying as well, amongst other houses like UBS, what they're saying in terms of their bear market guide, because nobody ever gives you this. Nobody ever tells you any of this. This guy, the chief investment officer at UBS, he and I read philosophy, politics, and economics at Oxford. Okay, so I've got a lot of time for him because he actually does know what the hell he's doing at UBS. Okay, and he's their chief investment officer. So I quite like UBS, and we went to university together. I know it sounds really like snooty, doesn't it? Listen, I was born in Armley in Leeds. If you don't know Armley, you know, my school overlooked a prison. World's richest are waiting for a new dip in stocks before buying. That's according to UBS Global Wealth Management. So guess what they're telling their wealthiest clients? hold off a little bit just in case the market falls. So is Goldman Sachs. This is what Goldman Sachs said. All right, they've analyzed every single bear market for the last bull and bear market for the last 100 years. They said what happens is they tend to go up, then they fall, which is what's happened with Corona, then they rise again, which is where we are now, and then they tend to drop for at least another year or so. This is what Goldman's are telling their wealthiest clients with a 60% probability. Now, if that happens, we need to make sure that the solutions we have, which are the ones I'm going to tell you now, the 7 strategies, accommodate for that as well. Accommodate whether it goes up or down. So get your pens and pencils ready because we're going to now go through the 7 strategies. Investor strategy 1, I need a bit of safety. I want to know, right, is the gurus buying as well? So I already told you some of the biggest hedge funds, these names, okay, and it came from that Hedge Fund Alpha and their best ideas report. These are the best ideas of them. But I also want to know, and it's my business to know, what's in this guy's portfolio, not because he's the greatest investor of all time or anything like that, but because it could be a self-fulfilling prophecy. And if he's buying, there's at least momentum. Okay, so it's my job to drill down and know in this, what's in there, what's he holding, has he added to it, got rid of it? Well, it's my team's job to work this out. And then that just gives me the start. That doesn't tell me I got to buy into it. That gives me the starting point to see, does that fit into any of my other strategies? Does whatever stock or exchange traded fund or index tracker basically I come up with, I then need to know, okay, that's just a name. I need to know, does it fit into one of the 7 strategies? I checklist on the softwares we use. I'll talk about that later. Timeline according to the strategy that I should hold it. Is there a stop loss according to the strategy in one of the 7 strategies? Time to review. Okay, will it be 12 months I review in? 24 months? What will it be? 9 months? And then do I buy more when I do a review, and so on. Okay, simple as that. Very systematic, methodical. You know why? Because I like smelling roses. That's why it's systematic and methodical. It's another way of me saying I don't like sitting in front of a computer screen. What I like to do is smell the roses. So I like to make things systematic, methodical, checklist. I used to fly planes and we have a checklist. Okay, we don't keep it all in here. We have a checklist. I like checklists. So something could be investment strategy 2 and investment strategy 1 and 2, even better. Investment strategy 2 is one of my favorites. Leverage big on low risk. What is that? Well, the S&P 500 is an index tracker of the US markets, 500 largest American companies. This is the performance since 1926. As you can see, 0 to 10% returns in 14 years, 10 to 20% return in 20 of those years, and over a 20% return in 35 of those years. In other words, you are more likely to get a 0 to over 20% return more often than not. In fact, there's a 1 in 3% chance you get over a 20% return. So do you see how my ambition to get 20% per annum, to hit that, to convert and make $1 million every 10 years per pot of capital, per pot of 100K, or for every 10K make 600,000. Do you see how that becomes more realistic, even on something as simple as a low risk index tracker? Why is an index tracker low risk over a long period of time? Well, because it's 500 stocks, not one stock, it's a basket. But I don't just have the index tracker of the S&P 500. That'd be way too simple. Given that this is low risk, I leverage. Look what I said, leverage big on low risk. How do I leverage? Certainly not spread bets or CFDs. That'd be stupid. You don't invest with a trading product. Similarly, you don't trade with an investing product, right? What we do, or what I do, and it's suitable for me, I'm not saying it's good for you, is I have 3 times leverage index trackers of the S&P. 3 times leverage means if the S&P goes up $1, I make $3. If it goes down $1, I lose $3. Listen to that bit. Okay, so it is, I would say, taking a low risk product, adding a high risk leverage and making it medium risk. Okay, and because I intend to hold the S&P 500 for my great grandchildren, I've elongated my time frame, which is the easiest way to mitigate risk. I therefore have turned it into a lower medium risk, a low medium risk, 3 times. So what are they? Well, these are some of the ones that I would say are my hold forever, low risk, which I'm happy to leverage. So I've got Amazon, but I've also got Amazon leveraged, because there's an exchange traded product. I can leverage it 2 times. So for every $1 that Amazon goes up, I make $2. And as you can see, on the base, I made 75%, but on this, I already made 26% in a month. Actually, slightly more than a month, since end of March. That's what these figures are from end of March, right? 3 times leverage, S&P 500, up 30% for me. Premier Oil. Premier Oil is a performance-based stock because of the price of oil. Well, that's up 33%. Apple is hold forever. Inovio is performance. So quality is Amazon, Inovio is performance, Apple is quality, Premier is performance, Wisdom Tree is quality, Amazon is quality, Tristel is performance, Microsoft is quality. Got it? bang. Can you see how 20% per annum is actually not that big a deal for me? Investing strategy number 3, I X-ray quality. What does that mean? Quality is actually an exchange traded fund. It's a tracker which has a basket of stocks which are filtered for being the highest quality companies. And as you can see, whilst it tends to go up and up and up and up and up, and it's fallen now, it will resume. So what's in it? I X-ray that to see these are the top 10 holdings in that by weight. So what I've done is I've disaggregated it. I've reverse engineered it and looked at these. But that's not enough, because you know what? 3M, despite the face masks, down 30% on that one. Oh, okay, let's break down which ones have made the biggest contribution. Well, Microsoft, Apple, MasterCard. Thanks, Alpesh. You're a bloody genius. Okay, give us some sexy names. I will in a second. But this is lower risk. Okay, X-raying quality is low risk as a strategy. So strategy 4A, what are the banks telling their richest clients? I'll tell you what they're telling their richest clients. See this red line? That's what the banks are telling their richest client. It is an average of the price targets the biggest banks are telling their clients this is going to achieve. Now, that was June, that was October, that was 2020. That, as you've read in my Financial Times columns, is always over optimistic by about 20%. Why? Well, because those analysts are probably stupid, but more likely they're just trying to get you to buy shit. All right. So they're about 20% over optimistic, but they create a self-fulfilling prophecy. Now look what's happened. This is Petrobras. Now Petrobras is listed on, it's a Brazilian oil company, but it is listed in New York. So I can buy it the way I would buy Microsoft if I go to Barclays stockbrokers in the UK. So I'd like to buy some Microsoft. They'll say, okay, or Petrobras. Now it's at $5, target $12. Let's say $10 because the analyst is over optimistic. Well, I get to double my money. When will that happen? I'm willing to wait 12 months to get 100% return. I'm only targeting 20% per annum after all. But if it took me 2 years, I'm still willing to wait 2 years to get 100% return. Do you mind doubling your money in 2 years? No. Is that guaranteed? No, it's investing. Of course, it's not guaranteed. Nothing's guaranteed, but it falls into what are banks telling their richest clients. That red line is telling. It's my job to get that data. It's my job to give it to you. Okay, Citigroup. It's at 42, targeted at 78. Let's say it only goes to 70. Well, that gives me about a 50 to 60% return. I'm willing to wait 12 months. Comtech, similar story. It's at 16, target at 30. Well, that would be 100% return, but let's say 80, and that'll be my time limit of 12 months because this is performance, not quality. Time limit of 12 months, and if in 12 months it looks like it's no longer in the strategy because the analyst has said no, right? Or it's hit that target, then I get out. Simple as that. Okay, and I reevaluate. Capri, you can see 134% to the upside. Assume some of the software we use tells us this, so it makes life easier. Let's assume it's only 100%. Well, I'll make 100% return. All right. Walt Disney, this one I picked for my sister. Only 44% upside, but I did tell her, hold it for 12 months. Well, actually, sorry, quality. This one was in the quality arm, and you know she wanted it for my nephews and nieces' school fees. So that was the safer one I gave her. Uber, 55%. Now you might say, Alpesh, Uber, are you kidding? What about this? What about that? What about this? What about that? And I'll say, whoa, this is based on strategy 4A. The relevant information for that is what are the biggest banks telling their wealthiest clients. The relevant information for that is not what are the biggest banks telling their clients plus what my dog walker told me or what rumor I heard or what random fact I know. No, those aren't relevant. Thank you very much though. What's relevant is what's the biggest banks telling their clients, right? That's what we're focused on. Focus, focus, focus. Viacom, 190% to the upside. Also happens to be in strategy 1, i.e. guru buys. The gurus are into this. The gurus are into Fox. Well, they all know Rupert Murdoch, don't they? 90% to the upside on that one. Okay, so I'm running through things, but I'm giving you a brief outline. Investing strategy 4B. What do big banks like to tell their clients? 4B. What else do they tell them? They tell them two things. Look at the Altman scores. What are Altman scores? A formula devised in 1969 by an academic. And what it looks at is this formula. You don't need to know this formula. It's my job to tell you what this means. What it does is it looks at the working capital of a company. Now you look out of the window and you tell me if working capital isn't the most important factor right now for all companies around the world. It also looks at retained earnings, which is how much capital profit did they save from the past. Okay, so how much working capital have they got and how much money have they got in the bank? Two very important factors, I think you'll agree. So you don't need to know why is it say 0.6 and 1.2 because you're not about to do an MBA. If that's above 3, the company's very safe. Anything under 3, and depending on how far under 3 it is, the greater the risk. It's like a sliding scale. Got it? Very simplified. I'll show you some Altman scores for British companies and American companies in a second, okay? And Chinese and blah, blah, blah in a second. The other formula you need to know is Croakey. You don't need to devise this or anything. I'll give you the Croakey numbers. This is a slide from Goldman Sachs Asset Management. I had lunch with Jim O'Neill when he was chairman of Goldman Sachs Asset Management about 5-6 years ago. This is something which Deutsche Bank invented, and Deutsche Bank Wealth Management uses it to tell their clients what they should put their money in, and Goldman Sachs uses it. Okay, and what Croakey does is it tells you the cash flow of a company against the capital and the assets. In other words, it's a bit similar to this. Banks rip other people's work off, right? It's a variation on that. It is basically how much cash flow can a company generate on the assets it's got. Guess what's important right now? This. But it's not this based on what journalists write. Never listen to financial journalists. If you don't believe me, right? See how it says secrets on the inside. What I'm referring to is my time at Bloomberg TV. By the way, Bloomberg TV are brilliant. My columns in the Financial Times, BBC, all the rest of it. What it's saying is financial journalists will make up all sorts of stories because people like reading stories. They're there to sell newspapers, okay? Don't get your stock tips from a journalist or a broker. For God's sake, you might as well get them from the dog walker or the taxi driver. No offense to dog walkers and taxi drivers, by the way. You're probably actually, by the way, dog walkers and taxi drivers are better than fund managers in my experience because they live in the real world, right? So this is important. So Croakey above 10%. We want over 10% cash flow from the capital invested. Why? Don't worry about it. It's what we want. So what are some figures? Here we go. Right? These are FTSE 350 companies, 350 largest of the UK companies, ranked by how much they've moved in the last 3 months. And these are their value growth ratings. What the hell's value growth? That's my own little algorithm, which beats all these bloody fund managers, but don't worry about that for now. I wanted to show you the graph on which it's based, if I can in a second. I don't think I've got it in. Right, okay, and the other one is the NASDAQ 100. Take a picture, do the analysis in your own time. These are not all picks, obviously. What it is, look, Croakey above 10, good. Alpesh value growth rating above 7, fine. Altman is well below 3, so that's not so good. You can do the homework. Remember, I told you I'm going to teach you. I'm not just going to throw you fish. I'm going to teach you how to fish. Now I've taught you how to fish. You find the fish in there, okay? You got to work for your supper. And these are the NASDAQ 100. Remember, NASDAQ's already recovered to where it is. There you go, Croakey's, Altman's, Alpesh value growth rating. I can't do fairer than that, right? And this is the reverse end of the market, which have fallen the most. And assume if they've fallen the most, they recoup, let's say Hive, which I bought, recovers some of that. Well, I should double, triple, or quadruple my money. It's got a value growth rating of 7. And even important, the target price is what the analysts are telling their wealthiest clients. It's going to get to 110. I think they're smoking dope. I'll be happy to get 100% return in that. Yeah, 100%, doubling your money in a year? I'm happy with that. Not certain. It's risky. It's investing. But there you go. Take a picture. You can have a look at all of those. Okay, that's Hive. Bought into it. Target price, I'd get a 399% return if it was true. Croakey only 4.9%, so I know I'm taking risk. That's why I'd put this into medium to high risk. Okay, National Express is in there. I also look at their fair value. What is fair value? It's discount cash flow. If you don't know what DCF is, it's what Warren Buffett uses. Okay, it is better than price earnings ratio. It is a way of working out. If you own an asset, let's say this is a share, this is only worth anything to you based on how much money you will get from owning this. Imagine it's a house. Well, it's worth future rental income. All right. If it's a share, it's worth future dividends and capital growth. Right. That's how we do it. How do you do those calculations? Again, lots of complicated formulas made simple by various software we use. Target price 101%. Guess what? Based on the fact that it's undervalued by 50%. If something is undervalued 50%, its target is 100% up. Okay. That's National Express. You might think, are you nuts? National Express? I'm just telling you what the biggest banks are telling their wealthiest clients. Not Lloyd's for me, I'm afraid. I love banking with them. I love the staff who work there. They're friends of mine, but not something I would be a shareholder in because I can find a better home for my money. Why? Because, well, they find new ways of losing each year. Not their fault. And they're only 25% undervalued. So not enough. Well, I mentioned a lot of stocks. How many should we own? How many should we own? Let me tell you how many we should own then. Given that I have mentioned lots and lots and lots and lots and lots and lots of stocks, how many should we own, my friends? Well, it's really simple. The number we should own is about 15. Why? Well, if you own 100, stocks, you're not getting the effects of diversification on risk reduction. All right. And if you only own one, well, all your eggs in one basket, then even an Amazon could go bust, even an index tracker could collapse. So we don't want to do that. By the way, how do we create portfolios? Well, either you can have stocks. So where it says US and foreign stocks, just assume that's stocks. And where it says bonds and short-term investments, just assume that's cash. Keep things simple, right? Aggressive growth means most things are in stocks, okay, of all your risk capital, and some of it is in cash. Let's assume aggressive growth for you means all your risk capital is in stocks. Anyway, the important thing I want to show you here is best 20-year return is for aggressive growth nearly 20% per annum. Well, 20% per annum, it's about 3% off, 3.5% off. 3.5% is the difference between, this is Fidelity who did this, and they said this is what happened. If you just pick random stocks, this is what ends up happening, okay? If you just pick random stocks. Now, given that if you pick random stocks, this is what ends up happening, here's something that's interesting. I've only got to try and get 3.5% more with all my skill and knowledge than what would happen if I just randomly had an aggressive portfolio. Or, to hit my target, by the way, of 20% per annum, or just 4.5% more than a growth portfolio, or just 6.5% or 6% more than a balanced portfolio. Now, I was asking a lot of things, but okay, well, I don't think so. I don't think it is. Actually, investing 5, cash flow is king. What does that mean? Again, looking at discount cash flow, I sort of hinted at it already. Alamas, for instance, is 50% undervalued. I get software to do this for me. National Express, I've already discussed and I said it was seriously undervalued. Baidu, it's not undervalued as much as I'd like. However, I wanted some exposure to a Chinese company listed in America. Baidu, as you will know, the Chinese block access to their markets. So Baidu cannot have access, so Google, who Baidu competes with, don't have access in China. Therefore, Baidu has 1.7 billion people as customers and does rather well. And the Chinese, I wanted exposure anyway. So cut a long story short, Baidu was in there based on that, and it fitted in investment strategy 5. Whenever somebody comes to me and says, what do you think of XYZ? I say to myself, does it fit into strategy 1, 2, 3, 4, 5, 6, or 7? Simple as that. Now, you might not use all of these strategies. You might only want to use 1 or 2. Okay. Investment strategy 6, higher risk. What is that? What is investment strategy higher risk? It is this. It's things like French Connection. What this says, don't worry about the little small print. Let me explain. It says, I look at things which are, and this is high risk, which over 12 months ago were a lot higher and were doing very well, thank you very much. And I work on the basis that whilst they've collapsed since the coronavirus, they will return to where they were over 12 to 24 months. And if that gives me 100% return, then I'm willing to get into them, because even if it took 2 years and I only got a 20% return, if it took 2 years and I got a 40% return, that's 20% per annum, I'm happy. Okay, that's higher risk though. Okay, that's higher risk. It is the will it return to where it was before coronavirus strategy, right? And then finally, investment strategy number 7, medium risk exchange traded funds. This is how you sort out your portfolio. All of these strategies, the decision-making decision tree, and then your tanked out pension fund folio, or your 20-something who wants to be a millionaire in 10, 15 years. This is how you sort it out. You pick one of these strategies, or all of them. Okay, this in the past month are all the exchange traded funds. Actually, not all, but a significant number of the exchange traded funds, which are index trackers from around the world. So you've got here, let's say you wanted to look at developed markets, but how do you know which ones to pick? This is global, okay, like gold. If you wanted gold, there's an index. So it's just like a stock. An index tracker is just like a stock. You buy like a stock and it tracks an index. This tracks an indices of gold mining companies. This nugget tracks smaller gold mining companies, okay? Some track the price of gold. Forget that for a second. US sectors. I have bought into semiconductors. Why? Well, what the coronavirus has done is accelerated and concertinaed and brought forward all the changes we were expecting to happen over the next 10 years. It's brought them forward probably into about a year. In other words, we're all using web conferences, we're using computing power more, we're going to travel less, we're going to be working from home more, etc., etc., etc. So I got interested in this index tracker. Now, let me tell you what's interesting. I can pick country-specific ones, I can pick commodity-based ones, I can pick international ones to do with emerging markets if I wish, I can do sector-specific, okay? But I still need to know which ones, right? So I will go into how do I pick which ones, or I'll just tell you which ones. So this is what I bought into. Information technology ETF, Medium risk. Why? Well, I look at how it's been doing before coronavirus. I see that it's dropped. I think it will resume because it's in bloody information technology. That's one area which is not going to suffer. How do I know this? Well, come on. Right. And what else do I own? I've already told you Amazon 2 leveraged. I own Brent crude oil 2 times leverage because I think oil will go from. So this is performance stock, which means it's got a timeline limit, or I'll review it in 1 year, 2 years, 3 years. I think oil will go from $20 to 60. Okay, which is a 3-fold increase because this is 2 times leverage. I'll get a 6-fold return in my money. That'll help me hit my 20% per annum, won't it? And make sure I convert those 10,000s into millions over a period of time for my son and whatever. Okay, Apple to forget T. Rowe Price for a second. Okay, and Legal and General, sorry, FTSE 100 leverage 2-fold. Right? Why? That's performance related. This is quality. This is performance, T. Rowe, and this is performance. In other words, I've got a 12-month time behind, and I'll revisit it. If I've not made a 50% return in 12 months on the FTSE, I'll make a reevaluation. Does it fit into one of my strategies or not? This is what you do. This is how you do it. Okay, you scan fast. US, UK, global ETFs. You monitor them frequently. You look at one screen. You look at not one strategy, but as many of the 7 as possible, please. So you've got diversification across strategies, across sectors, across the world. That's critical. Okay, 20 investments max, please, because the benefit, because I'll tell you why, when people start buying every single piece of crap they can get their hands on, you know what they're actually doing? They're saying they're swapping discipline of quality, okay, for buying choice. They just keep buying loads of stuff because I don't know which one of these is the best. I'll just buy them both. That's not how you pick a portfolio. Why? Because that portfolio is meant for your grandchildren. Do you want to poison your grandchildren? Obviously not. So you don't want to pick rubbish, okay? Diversify. Make sure they're not correlated. Stop losses in performance-related stocks, whether it's 25% or at the moment, you might want to do 50% stop losses, but halve your position size so you're not risking losing more money. Why 50% stop loss? Because the market's volatile. Quality stocks, if they fall, you just buy more. Stop loss is only for performance stocks. For quality stocks, there's no stop loss because you just buy more. Add to which, how do you know which quality? Well, I just described them through those 7 strategies. Add to quality, take profits in performance stocks if they go up and up and up. Okay, if they fall and fall and fall, then you get your stop loss and so on. 9 to 18-month periods. Don't do this between 9 and 5. Okay, do it over the weekend. Do it tomorrow. What I'm going to teach you, I'll show you how to get some of the data and information in a second. Do this over weekends. Why? Because when you do it in daytime, what happens is you're looking at your phone, you go, oh, I'll buy that. Look, the market's moving. I better buy that. Don't do that. Okay, you should spend about an hour to find a short list of 10 investments. It's not bad. Return on your time. It's a phenomenal return on time. All investing comes down to this: discount cash flow, which is one of the strategies, value growth income, which is looking at my the algo I gave you the results for anyway, what the big banks are telling their clients, Altman, Croakey, and then basically low risk, high rewards leverage using exchange rate products or ETFs. It's all investment is. This is one of these things, okay? Why do private investors get it wrong then so often? What does a winning Financial Times competition winner, that's me, do? And what does the ordinary 1.9% per annum poor performing private investor do? Let me tell you the difference. I know the data that's important. Sadly, the regular investor doesn't know what to look at. I know clear specific strategy for rising and falling markets. The poor guy doesn't have a strategy. I only add to quality picks. They add to poor quality losers. I have a strategy, so always know what to do. They panic on profits. They panic on losses. They just basically are panicking all the time. I'm shrewd on what I pay for. They buy and pay for expensive subscriptions. I have access to high quality, high value, super rich info. They rely on journalists and brokers. I'm efficient and get on with it, and then go smell the roses. They spend hours, get confused, and therefore buy because they've sunk time cost into an investment. This is me. I developed all of this when I actually bought, I borrowed £100 from my aunt when I was 12 years old, okay? And I bought some privatization shares. And so I've been doing this throughout university. Anybody who was with me at university knows this. That's me with Red Carnation, last exam, perfected the strategy, won awards in the Financial Times. My government picked up on me, pension funds found me, and then I set up my own fund. As a result, published books because the publishers found me and said, bloody hell, we should publish books around you. And I said, yeah, I'd like the profile because it allows me to then raise a fund, which is what I did. Number one, then you had all those people. The fund is not open to retail clients. I'll just tell you again. So then we were looking at this and people kept asking me, so no, because I was a retail investor, obviously, before I had the fund, because I was dealing with private investors, because I was writing in the FT, writing books. I was always dealing with private investors. And I said to people, what do you want? And they said, well, they said, well, we want you to teach us. We want one-to-one attention from you, but we don't want to be paying any kind of subscription. We want it to be convenient so we can do it in our own time, but we want access to you one-to-one. We want to be able to have calls with you, meet you if need be. As a regulated fund manager, and remember, I don't manage anybody's money. I'm not managing anybody's, well, I manage pension fund money, not you guys. Okay. They said, we don't want travel costs. I'm not connected to a broker. You can use whichever broker you want. I don't care. I can tell you which ones I think are okay, but it's up to you. Goldman Sachs info, they said we want this, we want ongoing support for life to sort things out, lifetime updates, daily updates. I give daily updates to people. This is the Telegram channel, the private channel that I put people on, and I give them my picks as well. It's not just mine. Let me just go to the bottom. I also tell them, as of today, I'm also going to be telling them latest trades of Steve Cohen, Jim Simons, Paul Tudor-Jones, Warren Buffett as well. So, for instance, top hedge fund the top holdings are Warren Buffett, what he's trading, as well as what I like, why I like it, and so on, and how my value growth income scoring is happening. So give them all of this, give them all this data as well on there. Make sure they've got access to all this data. Sorry, I don't want to make your eyes go wizzy, okay? But give them names of companies that I like and why I like them, etc., etc., and analyze them for them. All right. So they said they want all of this. I said, okay. And I thought, well, you know, I've got busy running. And they said they want access to the same software I use, but make sure there's no subscriptions. I thought, okay, so we had to find software for free for them, different, like 4 or 5 different types for free, because we don't want people paying subscriptions. And then anything which is paid for, I buy the subscriptions like Bloomberg and give the data to them. Okay, so I asked people, what else do you want? They said, well, we like the fact that you're a regulated hedge fund manager, professionally trained communicator, so you don't bore us. Bloomberg TV paid and Financial Times paid. Financial Times would pay me £1 a word for my articles, by the way. Bloomberg, £3,000 for my TV show per show. Academic research and development, visiting fellow at Oxford University in business, and I lecture on behavioral finance and won awards in the financial science. I said, well, we've got all of this. And so we thought, is there something we can do out of the hedge fund? Something that we're teaching our staff that we can take forward? Because we had no competition. There's nobody in the world teaching this stuff. Okay, there's nobody teaching this at all on the investing side, and not just teaching it, but actually showing people how to do it. And it's the same stuff that I use when I'm on the BBC. So I've got my neck on the block, and we had amazing credentials from people. So hedge fund managers like Bernard Opity, or the MD of Merrill Lynch, HSBC, CEO of American Express, the BBC, there's Philip Hampshire, Coutts Wealth Management, who manage money for Her Majesty the Queen. Let me zoom into some of these so you can see them properly. Okay, an essential companion for the online trader, Tom Collins. Well, here we go. Seasoned traders and new investors alike will learn much from no nonsense guide to the industry. We thought, you know what? We've got all these amazing comments from people and references. We've got to spin something out of the fund. We're going to make a global thing which could be worth bazillions, millions. Okay, so we thought, well, to do that, we're going to have to give people one-to-one access to me via WhatsApp. They're going to be able to see my trades, and those are the biggest people on Telegram. But for investments, okay, this is investing. It's not trading. This is investing. Investing means holding for long term. And there's one-to-one Zoom calls with them, one-to-one Skype calls. So we created a program for them, which is basically spun out of the fund. Okay, WhatsApp, Telegram. And what I've done is, and I did this at lunchtime, but I've done this impromptu today because a few people at lunchtime couldn't sign up in the end. So we got a couple of spare places. It's not 10, it's going to be 5. I'm going to give people 50% off on this webinar. Not 10 people, 5, only 5, okay? And the first 5. 50% off. But we thought if we're going to give them the whole course content, the access to the softwares, different types of software, which there's no subscriptions ever, I buy the subscriptions, give the data to them, the Telegram channel, the WhatsApp, the course material. And by the way, when I say course, it's actually not a course, it's actually a program, because it is updated every single day because of what's happening in the market. It's always updated, as is the software and my teaching, and access to me, daily access to me through Skype, Telegram, Zoom, all the rest of it. So we put that together and we thought, how do we price this? And don't worry, it's not £90,000. We thought, how do we price this? You know, you've got to work out benefits to people and value. And we thought, well, what's it worth within our own company? Okay, because obviously the staff in my own company have lifetime updates. And we thought, well, maybe lifetime updates is £10,000. Added value to your portfolio over 10 years? Well, I'd be pretty shocked if I can't add 50K to somebody's portfolio in terms of the education I'm giving them. Just like when you go to university, it adds to your salary, your lifetime salary. You will earn 200 grand more than somebody who didn't go to university. Well, is this education worth at least 50,000? So we lowballed it and said, yeah. Access to Goldman reports and all of that kind of stuff that I have access to. It's not just dumping a report on you. I'd say what's important, maybe 5K. Okay, data from premium subscription services at no charge, maybe 5K. Daily updates and tips from me, maybe 10K on that one. Always free software source for you. So we have 4 different sources. We get lots of different things we get access. You've seen some of it online. I've shown you some of it. That's the stuff we'll be using and teaching you, showing you how to use it so you can do the fishing yourself, but also giving you every day which stocks are moving, which we like, and a risk rating, but also every week and every month. So maybe that's £1,000. Lifetime access to a regulated fund manager, hedge fund manager. So, you know, the SAS of fund managers. 5,000? I don't know. I lowballed it. I really lowballed all of this. Obviously, my mom would say priceless. WhatsApp phone access, speak to me one-to-one on the phone, we'll go through stuff. 90,000, I thought, maybe. What we did is this. This was training, which, well, let me tell you who my most successful person has been. Naomi Waistell. She joined me as my assistant after university. At university, she read English. She joined me, worked for me for 3 years. We trained her up. She then left for Newton. She now manages $10 billion under management. Okay, it's that simple. It's that simple. Worked for me. I trained her up, and then we thought this program easily worth 90,000 because the girl made that back in about 2 months in her bloody salary. So yeah, I thought, you know what we're teaching is worth a lot. So what should we do? We thought, well, we don't want to be. What we want to do is float the damn thing. We want to take on apprentices like these 2 billionaires. We want to float the damn thing. We want to take the company, make it global, and float it, but have me as the mentor. So here it is. If you want to sign up, it's 50% off. 50% off, but only for the first 5 webinar attendees. Now, I've opened this up again, and I hadn't intended to from lunchtime because there were a couple of people who couldn't sign up at lunchtime on the links. That's where you go, alpeshpatel.com/1, or there's a backup site because every time we do this, it crashes the internet. Too many people try and get on, but it's only for the first 5. So if you ends up, so go to either of these, okay, and it is 50% off. The lifetime is normally £20,000. Now you might think, Jesus, how much? Actually, given the value we give, we had to do that. Okay, or you can have an annual one, which is normally 10,000, but it's 50% off. So the lifetime one is now 9,999, and the annual is 5K. Okay, plus VAT if it's use this code May50 on those websites. Okay, it's that simple. There is a 7-day no risk money back guarantee. Okay, for the first 5 webinar attendees only for the first 5. Now, if for any reason you want to do a bank transfer instead, it's that, boom, boom, boom. Because last time somebody said, oh, no, we need to wire, we can't, the links just have come down. It's too many people. When you go to alpeshpatel.com shares, this is what you will see. You click there, you put the coupon here. Look at that where you put the coupon. That will remove £10,000 in cost. Okay, May 50. Or you go to shares 1, in which case the discount is already embedded. You do not need to put the coupon. If you go to shares 1, it is embedded. That discounts the 10,000. It's that simple. I'm only taking on 5 on this, and you can imagine why we've had to. Originally it was 3, then we put it at 5, then we put it at 7. Now it's at 10, and it's going to. And normally it's going to be 20, and it's going to go up even more next week. And the reason for that is it's a bit like airline seats. As you fill up and get more people, the prices has to go up because I need to maintain the quality of my time I give to you guys. Okay. And not only that, this is Peter Curtis, chairman of CMC Group. Alpesh's insight into the market and trading are must read for traders in all levels, beginners. There is something for everyone. Michael Fuchs, CEO TD Waterhouse. Find out how one of the best UK known traders and broadcast uses wealth of information out there. You have got John Watson, co-chairman CNBC, the lid of the traders black box finally and truly removed. Okay. That's what it is. That's what it's about. What I do is I take people through, give them the business plan. We practice, test, they get the course material as well. We want this company to be a billion-dollar company global, because there is nobody giving this kind of access to that quality of information anywhere in the world at all. And that made us realize that actually we're in a unique position. Nobody else has got the skill set. Nobody's got the abilities. Nobody's got the know-how. It's as simple as that. So as you do sign up, please let me know. You can put it in the private box as well. There's a private box somewhere in there. Just let me know. Okay. And it's for 5 people only. Hope you found this useful. Let me know any questions you've got. I don't want to have missed any questions from anybody at all on these webinars. And by the way, we keep improving. We keep adding things on the private Telegram channel. This is what I just added today. I bought into NXP Semiconductors. Why? Because I said 2 new services I'm launching as part of the package. And this is for people who are already on. I'll be showing the latest trades of the 4 greatest investors. Okay. And then I'll be analyzing those to see which I like and why and which strategy it falls into. So it reduces the risk levels and generates more ideas. I've also started giving this, which are the holdings of some of the biggest fund names because it's my job to have access to subscriptions, which gets that and then give that to people. So a bit of a Robin Hood, get the data, analyze it, and get, pass it across and work out what's important for people. Okay, it's as simple as that. All right, on that basis. Let me know any questions you've got whatsoever. Anything that I have missed, let me know. May 50 is the discount code. It's May 50. You go to alpeshpatel.com. Shares is where you'd need the discount code. If you go to that link, you'll need the discount code. You put it here. If you go to shares one, you don't need it. By the way, if any of you got difficulty signing in, because this happened before at lunchtime because the internet breaks, or you want to do a bank wire transfer, let me know and I will tell you. I will just put your email in. Just give me your email address and I will send the direct link to that with the discount on it. The discount's only going to apply for the webinar. I wasn't even planning to do this one. But I had so many people emailing me saying, please, can you do it? They couldn't do the lunchtime one for whatever reason. And so I said, yeah, okay, look, I'll do it. But then I want to make a run because it's 8:45. And I love doing this. I love teaching people. I have absolute enthusiasm because I started when I was 12. And I've loved the markets for some reason. Actually, it's because I love the idea of somebody else is working to make me money. The owner of Amazon's working to make me money and so on. That was the reason why. Any questions at all, just let me know. Any questions at all, I want to know. Other than that, as you sign up, let me know as well. Thank you. I am excited you are on board as well. Thank you very much. There we go. We had you can't be the same Costas. We had a Costas sign on. No, you're not. You're different. Good. Sign earlier. Patrick, thank you very much as well. I got the message. Good. No worries as well. That is good. I'll just send you a private chat with the link, actually. Don't worry. I'll send you a private chat with the link. Anybody else? Oh, you're having difficulties getting on. Let me know if you are. I will send you an email link because sometimes these links, if there's too many people, the internet thinks all of a sudden it goes, there was no traffic. And then now, into the webinar, it's suddenly traffic on these two hidden links. How come there's traffic? And that's the reason why. Our ambitions for this, I'm afraid I have had to increase the price from what you saw last week, and I'm afraid next week it's going to be even more. Okay, it's just the way it is. And the reason for that, I'm afraid, is because of popularity. It is simply as that. It is because of popularity of the product. Okay, and that's the reason for it. Okay, let me know any questions about any of the stocks, any of the strategies, any of the methodologies, anything that I've taught you, things that you want more of, things that you want less of. Okay, as well. Thank you very much, Alan. Thank you. Kapil as well. Carl, thank you very much. Thank you as well. I'm delighted. I'll send you an email straight after this. And yeah, no, you can go for the annual. That's perfectly fine. It's very easy to upgrade to the lifetime if you wish. But the annual is perfectly fine. Don't worry, you get the same full access on the annual. I will look forward to welcoming you on board. Thank you very much. Look forward to welcoming you on board as well. Any questions at all, let me know. If there's no questions, I'm going to make a move because this is great. I've got 3 or 4 already on. I will let whoever it is fastest finger on the keyboards to fill the remaining 2 seats. And then I'm going to send you all an email. Send all the ones who've signed up. Okay, thank you very much, Wade. Appreciate it. Appreciate the comment. Thank you very much indeed. Okay, delighted for everybody who's been on. Whoops, there we go. No, answered that one. Good, answered that one. Got to make sure I've answered all the questions. Okay, if there's anybody I've not answered, just let me know. I think I've answered everyone. Good. Listen, guys, thank you all very much, apprentices and students and the new ones who've come on board as well. I'm delighted with that. And those, as I said, other links, any issues at all, just let me know with it. Because I said I'm worried about how the links. Oh, I got to show you the course material. Of course I do. What am I saying? There's the course material. I'm going to show you this. Okay, this is phenomenal. So it's updated every single day. Why? Because the markets move every single day and people join at different times. So I update this absolutely every single day. Just got to make sure that that is, yep. And what you would see here is, click there and you will see not just the softwares that we use. I say softwares in plural, probably grammatically incorrect, but because we use 4 different ones which are free to private investors, we sourced stuff which gave the information you needed, but free. Okay, and then there's others which have subscriptions to get the data, like obviously what's Warren Buffett just bought and what's in his portfolio, and I get that. I pay for those subscriptions and make sure you've got access to that kind of data, and we're updating and upgrading all the time, so all those upgrades are there, and then show you my favorite tools as well as of the big banks, a roundup of those strategies, again explained to you, and it gets better, the latest reports from Goldman's, UBS, Bank of England. I even explain it so you don't have to read the whole darn thing yourself, so it's not too dull and boring for you guys either, and so on. And a copy of my book, Investing Unplugged. Actually, you'll also get physical copies of my book and a USB on investing as well, and you get a physical signed copy of my book as well. And of course, Skype calls with me, Telegram calls, Telegram broadcasts, and we'll meet up as well to the students of mine or apprentices of mine. And just like Lord Sugar's apprentices and just like Donald Trump's apprentices, I want you to become millionaires. If you're already millionaires, even more so. That's the ambition. The same ambition as Warren Buffett has for apprentices and Donald Trump has for apprentices and all the rest of them have for apprentices. Okay, so thank you, Sandeep. I want to thank Sandeep, Wade. I want to thank Michael. Thank you, Ricky, Rakesh as well. Thank you very much, everybody who's been on here. We've got a lot more actually, which is in here. And there's an advanced section. Now, some of you want to be fund managers. Some get this for their kids and they say to their kids, I want you to learn this because you're going to be managing the family money and whatever else it is. Well, we do all of that stuff and it's updated every single day. Old things are removed, new things are put on. And it's my little baby spun out of the hedge fund, and it's a company which is going to be floated. It's as simple as that. And probably on the London Stock Exchange. We've got customers, as Wade will testify, from around the world, okay, which is great as well. So if you've enjoyed the webinar, please let me know in the question and answer bit. Please let me know you've enjoyed it. Tell me bits you like, tell me bits you want me to improve upon, anything like that. You just let me know what you like, what you want to change, what you want to improve upon. The 50% discount, I'm afraid, is only for the webinar. Other than that, it's full price. Okay, because there's a lot of costs that go into all of this and providing this kind of data. And because of that extra cost, it is only for the webinar that there's a discount, and it's only limited for the first 5 as well. So if you can't get on, you can't get on. Sorry about that. It is then closed. And some of you will know, Wade, you got on for, let's just say a little bit less than that. But now if you were trying to get on, my friend, there you go. That's what we're looking at. Okay. And it keeps improving and updating every single day from my perspective. So thank you all very much. I am going to now go speak to my lovely students on the other side. And don't forget, it's a 7-day risk-free guarantee. Any issues with the invoicing, just email me or let me know, and I will send it to you with the company details or a link through which you can use American Express, Visa, or MasterCard, or you just go to those links and you can use American Express, Visa, or MasterCard, or PayPal if you wish. I can also sort you the team, my secretary will sort you out on PayPal as well if you wish. Okay, everyone, let me know any feedback. Thank you. Everyone who's commented on all of this, really appreciate it. Thanks, everyone. I am going to, right, what am I going to do? I'm going to stop sharing if I can. Stop share. There we go. That's me. I want to give you a big radar on this. Yes, PayPal is. It was one of the companies that I did the analysis for my students on there. So PayPal was on the radar, very much so. And I can't remember what analysis I put on, but I put it on. Anything we find, we put first to my students, even before we look at buying it, trading it, or mentioning it on the BBC or anything else. Okay, so just so you know. Okay, thanks everyone who's been on. I'm going to call it a day in that case. So I want to thank everyone, and thanks everyone who's been watching on YouTube as well. Thank you very much.